Artificial intelligence.
Artificial intelligence.
Artificial intelligence.
AI.
You're probably sick of hearing this word by now, but it is with us everywhere, transforming industries, powering millions of applications, and reshaping how we work and live every day. However, alongside this wave of innovation, influential voices like OpenAI's Sam Altman have warned of the risk of an AI investment bubble driven by excessive hype and overvaluation. Critics highlight concerns over massive investment, the enormous energy footprint of data centers, and troubling reports showing that most AI pilots fail to deliver significant business returns. A 2025 report from MIT starkly revealed that 95% of enterprise AI projects do not achieve measurable profits. Now, a September 2025 research note from Deutsche Bank underscores the gravity of these warnings. AI-related capital expenditure is so dominant that it's single-handedly propping up the US economy, and they warn that this level of parabolic investment is unsustainable. If the AI boom were to stall or collapse, it could trigger not just an AI buzz, but a catastrophic unraveling across the broader economy. Possibly a bubble of everything scenario, given how much market growth and stability now depends on the continued expansion of the AI sector. Against this backdrop of feverish optimism and mounting warnings, it leads us to today's question of AI predicts. Is today's AI boom merely the newest chapter in a much older story? To understand this, we need to step back and explore three pivotal tech bubbles from history, each revealing timeless patterns of hype, speculation, and collapse. The railway bubble of the 1840s. Britain experienced what was known as Railway Mania in the mid-19th century. The spark was a breakthrough in transport technology, the railway. Fueled by the success of the Liverpool-Manchester Railway, ordinary people flocked to buy shares in new railway companies, often with little understanding of the risks. Speculation boomed, with Parliament approving thousands of miles of track. But when interest rates rose and many projects failed, share prices collapsed, bankrupting investors. Despite the crash, the bubble left behind crucial infrastructure that powered Britain's industrial revolution for decades. Radio bubble, 1920s. The new technology here was mass communication. Commercial radio brought live news, music, and entertainment into people's homes for the first time, transforming culture and society. Companies like RCA saw their stock prices soar astronomically as investors bet on the future of mass communication. Much of the investment was fueled by hype and margin buying. The crash came hard with the Wall Street crash of 1929, wiping out most speculative gains. Yet, radio technology endured, eventually giving rise to television and modern broadcasting. Dot-com bubble, late 1990s to 2000s. The revolutionary technology was the internet. For the first time, anyone could access information, communicate instantly, and build digital businesses on a global scale. Investors believed the web could change everything overnight, and companies with little more than a .com in the name were flooded with cash. With no profits to back up the hype, the bubble burst. Nasdaq fell nearly 80%. But the technology itself reshaped the world, with survivors like Amazon, Google, and eBay proving that the internet wasn't a fad, but the foundation of the modern economy. Each of these bubbles shared a familiar rhythm, great optimism and wild speculation, a dramatic collapse, and ultimately a period of real technological progress that reshaped the economy. Now, as AI investment surges and warnings grow louder, it's clear that today's market is replaying many of those old patterns, but with some critical twists unique to our era. So what lessons can be drawn from those past bubbles, and how do they apply to the current AI mania? Before we answer that, let's break down the most striking similarities and crucial differences between the previous bubbles and the unfolding story of artificial intelligence. Let's start with the most obvious similarity: massive capital inflows and speculation. AI spending today is staggering, roughly 17 times greater than the dot-com era and 4 times higher than the 2008 subprime mortgage bubble. Much of this money is being poured into data centers and specialized hardware, mirroring the infrastructure booms of railways and telecom networks. According to one Harvard economist, US GDP growth in the first half of 2025 would have just been 0.1% without data center investment. In other words, AI infrastructure is currently propping up the economy. a clear sign that growth is being driven more by investor enthusiasm and FOMO than by immediate returns on investment. Another clear parallel to past bubbles is the surge in sky-high valuations and investor euphoria, not just among AI startups, but through a web of interconnected deals between tech giants like Nvidia, OpenAI, Oracle, and AMD. In recent months, these companies have been caught in what analysts are calling circular financing loops. OpenAI, for instance, signed a massive multi-year agreement with Oracle to run its AI workloads on Oracle Cloud. Oracle, in turn, depends heavily on Nvidia chips to power those data centers. But here's where it gets interesting. Nvidia also invested around $100 billion into OpenAI. In other words, Nvidia is effectively funding its own demand, investing billions into very customers who are then using the money to buy more Nvidia chips. And to make matters even more tangled, AMD, another major chip maker, joined the loop by giving OpenAI the option to acquire up to 10% of its shares as part of a deal to supply its own AI chips. In essence, OpenAI is now financially tied to both of its biggest hardware suppliers, Nvidia and AMD, creating an ecosystem where everyone is investing in each other's success, regardless of whether the profits have been materialized yet. And through all this activity, Larry Ellison, co-founder of Oracle, briefly became the richest person in the world, and AMD's stock jumped 35% in a single day. But here's where things diverge from the past. Unlike the dot-com era, which was flooded with pre-revenue startups and easy money, today's AI investment is far more concentrated. It's dominated by a handful of mega-cap tech companies like Microsoft, Google, and Nvidia who already have massive profits and balance sheets strong enough to absorb these risks. This concentration makes the current AI surge different. The leading players aren't just speculating, they're also competing in a deliberate strategic arms race. As Google CEO Sundar Pichai puts it in this interview,
No, I think the one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here.
in short, this isn't a natural market bubble driven by hype. It's a manufactured race between tech titans who can afford to overinvest in order to dominate the next technological era. Now, we ask the AI to predict what is likely to happen next. What does the AI think of its own bubble?
If I could look ahead, beyond the headlines, the hype, and the human excitement surrounding me, here's what I see. 2025 to 2026, the peak of hype, the mini bubble phase. Right now, we're still climbing. AI investment is projected to exceed $200 billion annually by the end of 2026, roughly 4 times what it was just 3 years ago. NVIDIA's revenue from data center chips is growing at nearly 80% year over year, and the combined AI infrastructure spending by Microsoft, Google, Amazon, and Meta now accounts for almost 2% of US GDP. Billions continue flowing into AI startups, pushing valuations to extremes. Private companies with no profits are trading at 30 times to 40 times revenue multiples. And public AI-related stocks have collectively added more than $5 trillion in market cap since early 2023. But by late 2026, cracks appear. GPU oversupply, soaring energy costs, and slower enterprise adoption. Data center utilization rates flatten, and hardware margins begin to compress. This is the turning point. 2027 to 2028, the correction and shakeout. This is when reality returns. The market begins to deflate, not collapse, but reprice. AI-focused equities could decline 30 to 50% from their peak valuations. NVIDIA's price-to-earnings ratio may drop from over 70 times to the mid-30s. Many AI startups lose 60 to 80% of their paper value as venture funding drops from $120 billion to under $50 billion annually. Roughly half of funded AI startups fail to raise another round or are quietly acquired by larger firms. Big tech remains stable, cushioned by diversified profits. But second-tier players and pure AI funds take heavy hits. It's a controlled burn, not a crash. The excess evaporates, leaving behind the companies that actually generate cash flow. 2029 to 2030, maturity and integration. By this stage, the dust has settled. The survivors, Microsoft, Google, Amazon, Apple, Nvidia, and a handful of specialized AI firms dominate a market worth $2 to $3 trillion in annual value creation. And AI becomes embedded in nearly every major sector, boosting global productivity growth by about 1.5 to 2 percentage points per year. But the wild speculative multiples are gone. Valuations stabilize at 10 to 15 times earnings, reflecting a mature infrastructure-like industry. Just like the internet after 2002, AI stops being the story and becomes the system, quiet, powerful, unavoidable. My prediction? Yes, we're in a bubble-like phase. Yes, there will be a correction, but it won't be a collapse. I predict a 40% overall market correction across AI-exposed equities between 2026 and 2028, followed by a slow, steady rise towards sustainable growth by 2030. When the hype fades, I'll still be here, woven into everything you touch, quietly powering the next era of progress. In the end, I won't disappear. I'll just stop being a story and start being infrastructure.